Wall Street is completely, absolutely obsessed with AI right now. But let's be totally honest with each other. Most investors out there, they are buying the fancy paint instead of checking the actual foundation. Welcome to Iron Financial. I am your lead analyst, and my mission today, as it is every single day, is to help you forge a much stronger, more resilient portfolio. We absolutely do not deal in fluff on this channel. We deal in pure structural integrity. We're going to look at the balance sheets, we're going to audit the revenue streams, and we are going to dissect the operating margins to see what is actually built to last in what is, frankly, a very unforgiving market right now. And I'm the market skeptic. My job here is to represent you, the audience. I always want to know if the companies we are analyzing are actually pouring solid concrete or, if they're just quickly painting over the cracks in their foundation, hoping nobody comes along and notices. We really need to cut through the broader market weakness and that relentless Wall Street hype to find the actual ground-level truth. Before we dive into the blueprints today, do us a quick favor and make sure you hit that subscribe button so you never miss an explainer. All right, let's get into it. Today, we are running a massive deep dive stress test on a company that has placed itself directly in the crosshairs of the AI and data center megatrend. We are talking about Semtech, ticker symbol SMTC. So, we are framing today's entire debate around Semtech's absolute blowout first quarter for fiscal 2027. We are talking about record revenues, we're talking about expanding profit margins, and a super aggressive forward outlook that, honestly, caught Wall Street completely off guard. And the craziest part? They are doing all of this despite an incredibly tough macro environment. You've got persistently high interest rates actively squeezing capital expenditures across the board, yet Semtech is putting up these numbers. Okay, hold on, let's not get vertigo just yet. Yes, the numbers on the surface look like a skyscraper going up at record speed. It looks great, but my question is really simple. Is this massive rally built on a genuinely solid foundation, or is this just a fragile trap waiting to collapse under its own heavy weight? Because when a stock runs this hot, and I mean this fast, you absolutely cannot afford to skip the inspection. You've got to check every single weld and rivet. That's a totally fair point, and that is exactly what we are going to do today. We are taking the hard hat approach. We're going to drill all the way down into the financials, analyze the real end market demand, and seriously stress test their debt load to give you guys the final verdict. Let's actually start with the price action, because this is exactly what is making retail investors dizzy right now. Just look at this number, $164.46. Following this Q1 earnings report, Semtech shares surged super sharply on very heavy volume, pushing dangerously close to their 52-week high of $168.29. I mean, just a year ago, this stock was trading in a completely different zip code. Investors who actually held on through all that gut-wrenching volatility are either absolute visionaries or they just completely forgot their brokerage passwords. So we have to ask, is this genuine structural integrity driving the price action, or is Semtech just catching a free ride on the pure, unadulterated AI data center hype train? It's a valid question for sure. The broader market is obviously ravenous for anything even tangentially connected to AI and data centers right now. But listen, you just don't hit $164 on massive institutional-level trading volume just from issuing a flashy press release. You literally need the underlying math to support the structure. And when you actually sit down and audit Semtech's trajectory, the math is incredibly compelling. Let me show you the receipts.
The corporate filings actually prove this isn't some overnight sensation. Management has been successfully pouring the concrete for years. We are looking at highly consistent top-line growth across multiple fiscal periods here. Total revenue jumped from $757 million back in fiscal 2023 to $869 million in 2024, and then surged again to $909 million in 2025. Capturing these emerging markets takes literally years of groundwork. You have to fund all the strategic R&D, design the complex architectures, and, most importantly, get your chips validated by the hyperscalers long before those massive purchase orders ever come rolling in. This upward trajectory shows us they've been successfully laying down the rebar well before this current AI frenzy even took over the financial headlines.
Okay, sure. Historical top-line growth is great for a museum exhibit, but I want to know about the weather right now. Past performance absolutely does not pay future dividends. That's especially true in the semiconductor sector, which, let's face it, is notorious for brutal boom and bust cycles.
You want right now? Okay, let's look at the raw strength of their current operational memento. Right now, they are riding a massive streak of 9 consecutive quarters of net sales growth. 9 quarters. In Q1 2027, they hit a record $291 million. That is up 6% sequentially and a massive 16% year over year. They literally blew right past the high end of their own executive guidance. Think about that for a second. In a tightening macro environment where other hardware companies are out there issuing warnings, Semtech is accelerating. That isn't just momentum, that is an acceleration in real, tangible demand. They are locking in strong bookings and building a really massive backlog.
I hear you. A 16% year-over-year top-line growth is certainly a heavy payload. I won't deny that. But you know the old saying, revenue is vanity, cash is sanity. Anyone can build a multi-million-dollar mansion if they are willing to take out a massive, crippling mortgage to do it. Let's pull up the floorboards and actually look at the balance sheet, because that is exactly where I am seeing some serious stress points.
All right, here is the reality check, and we really need to slow down to appreciate the gravity of this. You look at their liquidity. They have $163.3 million in cash and cash equivalents. Okay, decent cushion, right? But then you look across the ledger at the debt. $492 million in long-term debt. That is a heavy, heavy load-bearing wall to be relying on. In this specific macroeconomic environment, where interest rates are elevated and capital is decidedly not cheap, carrying $500 million in debt is a massive, glowing red risk factor. If there is even a slight tremor in end-market demand, the cost to just service that debt can completely crush the equity. Look, the debt is a known structural factor, and yes, it requires a lot of heavy lifting to service. But you are totally ignoring their fundamental ability to actually generate the cash to support that structure. In this exact same quarter, they generated $36.2 million in operating cash flow, which, by the way, is up 30% year over year, and $28 million in pure free cash flow. That $28 million isn't theoretical. It allows them to steadily service those debt obligations, fund ongoing R&D, and keep the lights on without having to go back to the market and dilute the shareholders. Plus, let's drill down into how incredibly profitable those sales actually are. Let's really look at the financial granularity here, because this is where the story gets really impressive. Comparing the GAAP to non-GAAP results shows exactly how strong the underlying business engine is operating. Their GAAP diluted earnings per share came in at 27 cents, up 23% year over year. But when you look at the non-GAAP adjusted diluted EPS, which strips out all that one-time accounting noise and amortization, it was 51 cents. That's a 34% increase year over year. But here is the ultimate structural integrity check. Look at the adjusted gross margin, 53%. And within their core semiconductor products, gross margins were 60.7%. 60.7%. In the physical semiconductor hardware space, that isn't just good, that is elite territory. It tells me they have an absolute monopoly on pricing power right now. They are not selling commoditized, run-of-the-mill chips where buyers can just haggle over pennies. They are selling highly differentiated, premium solutions that their customers absolutely must have. Okay, I will admit, 60% plus gross margins in physical hardware is the exact kind of high-grade steel you want in a portfolio. But why gross margins only matter if corporate operating expenses are actually kept in check? Otherwise, you're just bleeding cash out the back door and it means nothing. And they absolutely are keeping those expenses in check. CFO Mark Lin wasn't mincing words on the recent earnings call. He specifically called out their execution, stating they, quote, demonstrated meaningful operating leverage in the first quarter. He went on to say that these operational fundamentals provide a direct foundation for improving metrics and driving real shareholder returns. This is a really crucial concept for everyone to grasp. Operating leverage basically means their revenue is growing much faster than their fixed operating costs. In Q1, their adjusted operating expenses actually came in slightly below the low end of their own guidance. Selling, general, and administrative expenses, or SG&A, dropped by 200 basis points year over year as a percentage of sales. They are actively cutting the dead weight and tightening the bolts on the entire business while the top line continues to expand.
Okay, so the machine is operating efficiently, but let's break down the actual end markets to see what they are building on top of it. Industrial is their biggest pillar by far, bringing in $153.9 million. Infrastructure is the second pillar at $98.8 million, and high-end consumer is just a distant third at $38.4 million. My immediate concern here is that massive industrial segment. The 10K filings explicitly mention macroeconomic conditions, stuff like market volatility, inflationary pressures, elevated channel inventories. If the industrial sector starts to pull back on IoT deployments or predictive maintenance upgrades because of a looming recession, like, say, smart factories deciding to pause their capital upgrades just to weather the storm, that $153 million pillar could start to crack really fast. How structural is that demand really?
Well, the industrial segment is actually currently stabilizing, particularly with their LoRa technology hitting all-time highs. But if you want to talk about true rock-solid, load-bearing pillars, you need to look at the data center segment. Data center net sales just hit $71.6 million. That is up 14% sequentially and a massive 39% year over year. This is the ultimate growth engine for them right now. They are literally supplying the critical physical infrastructure for the AI boom.
We are talking about massive demand for their 800 gigabit fiber edge portfolio and linear pluggable optics, or LPO technology. Just to break that down simply, linear pluggable optics is basically the ultra-fast, super energy-efficient nervous system that AI data centers desperately need right now to prevent bottlenecking. The hyperscalers literally cannot build out their AI networks without this exact tech. Plus, Semtech's recent acquisition of HIFU brings indium phosphide photonic products into the fold, which are the strategic building blocks for the next generation 1.6 terabit and 3.2 terabit optical modules. Actually, scratch that. It's not just a trend. This is a massive secular shift in global computing infrastructure, and Semtech is successfully laying the fiber for all of it.
Market skeptic, acquisitions always sound great on paper, right? Until the bill actually comes due. I refuse to ignore the past here. Just 1 quarter ago, in Q4 2026, Semtech recorded a $44.6 million goodwill impairment. In regular Wall Street terms, a goodwill impairment is basically management publicly admitting they bought a lemon. It means an asset or brand they acquired in the past is actually worth significantly less than what they aggressively recorded on the balance sheet. We also saw in their annual report a noted material weakness related to the integration of Sierra Wireless, which was a major acquisition they made back in 2023. These are massive cracks in the armor. It signals to me that management has a history of overpaying for assets or failing to integrate them properly, which completely rots the foundation from the inside out. How can we trust their new acquisitions won't suffer the exact same fate?
And frankly, it gets so much worse when you read the fine print. I went deep into the weeds of their 10K filings to look at their strict credit agreement covenants. This outlines the intense, heavy lifting management is legally obligated to do by their lenders. They have to drastically scale down their maximum consolidated leverage ratio. Right now, it's allowed to be a bloated 7.68 to 1.00. But they have to aggressively step that down over the next several quarters, eventually hitting a suffocating 3.75 to 1.00 by April 2026. That is an incredibly tight timeline to aggressively delever the balance sheet. If earnings slip even a little bit, or if those shiny new data center orders get delayed by even a few months, they run the very real risk of violating these debt covenants. That puts a hard steel ceiling on exactly how much margin of error management actually has to operate with right now. Look, you are completely right that the debt covenants are tight. No arguing that. But management isn't just sitting around in the site office hoping earnings naturally cover the spread. They are actively repairing the cracks and redesigning the floor plan to fix the leverage problem. CEO Hong Q Hao explicitly addressed this exact issue on the earnings call, stating, "We are pleased to report the divestiture process for our cellular module business is at the final stages. Discussions are progressing well." This is exactly what you want to see a management team do when they are boxed in. They are intentionally divesting non-core, lower-margin businesses to optimize the entire portfolio. Selling off the cellular module business will bring in an immediate massive injection of capital to pay down that exact debt load you are so worried about. It cleans up the balance sheet while allowing them to focus 100% of their R&D budget on high-margin winners like data center optical chips and LoRa IoT sensors. It's textbook execution. Furthermore, the demand for those high-margin products isn't just speculative, it is incredibly tangible. On the earnings call, management triumphantly confirmed they are initiating massive capacity expansion plans right now. They are literally increasing production 2 to 3x current levels to meet incoming demand. They are locking in near-term investments across their foundry partners, their testing partners, and their OSAT network. For those unaware, OSAT stands for Outsourced Semiconductor Assembly and Test. It's a critical choke point in the global supply chain where the actual chips are packaged and verified. Listen to me, you absolutely do not build a bigger factory or contract for triple your previous capacity unless your order book is rock solid. They specifically noted that demand for their GaN chips currently exceeds their available supply. This is a company scrambling to build enough product to satisfy aggressive hyperscaler demand. And that robust, unyielding demand leads directly into their forward guidance. When you look at management's actual blueprints for Q2 2027, the structure looks exceptionally strong. Management is guiding for net sales of roughly $328 million. That represents a 13% sequential increase and a 27% jump year over year. They expect adjusted gross margins to expand even further to 54%. Adjusted diluted EPS is forecasted at $0.61. But you want to know the most staggering number in this entire blueprint? They are projecting a massive 35% sequential growth in the data center segment alone, which equates to an 85% year-over-year explosion. 85%. That is pure, undeniable structural strength. So let's deliver the final verdict for our viewers.
On one side of the ledger, Semtech has poured a remarkably solid foundation. They are experiencing a massive data center boom driven by 800G and optical demand. Their LoRa IoT business is hitting all-time highs, and they are actively making smart, strategic divestitures to clean up their portfolio and expand margins. Right. But on the other side, we simply cannot just ignore the cracks in the armor. They are carrying highly restrictive, high-leverage debt covenants that require absolutely flawless execution to navigate. There's lingering macro uncertainty in the broader industrial market, and they carry a history of costly past impairments and integration issues that definitely make you question their overall M&A strategy. It ultimately comes down to whether you believe the sheer velocity of the global AI infrastructure build-out will generate enough cash flow to allow Semtech to outrun those debt obligations. The numbers point to a company that is successfully executing a massive, high-wire, heavy-lifting act. It's a high-stakes stress test, without a doubt. So we turn it over to you. As always here at Iron Financial, our mission is to give you the blueprints so you can forge a stronger portfolio. But in this market, you have to do your own inspections. Looking at the data we just covered, is Semtech a structural breakout you need to buy or a heavy debt trap you need to avoid? Let us know your thoughts in the comments. Thanks for joining us on this explainer, and we will see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.